Welcome to the Equilibrium Frequency podcast. In studio is Pat Magadla, Head of Distribution. And joining her is Lorenzo La Posta, Portfolio Manager at Momentum Global Investment Management. They will be discussing navigating a changing global landscape amid growing uncertainty.
Welcome, Lorenzo. Today I'm looking forward to our conversation about all things global markets and introducing the Equilibrium Global Model portfolios. So from an Equilibrium perspective, we've got 3 risk profiled global models. So we've got the Equilibrium Global Cautious, Equilibrium Global Managed, the Equilibrium Global Growth Fund. These are USD hard currency denominated funds, and they're managed by our UK team out in London. And Lorenzo is one of the portfolio managers, and I'm pleased to have him here today. Lorenzo, maybe to kick us off, let's talk about the people piece, so the team. What would you say, in your mind, is MGIM's competitive advantage?
Well, thank you for having me in the first place, Pat. And I've always thought our edge is knowing ourselves in a way. We know the things we're good at and the things we're not. We try and do as little as possible that we're not good at and focus on the value add. For example, we're not stock pickers. We don't buy stocks ourselves. We're not great at doing that. So we'd rather spend our time investigating managers that are instead experts at their job. And we scout for them all over the world. We work with people based in the States, in Australia, in South Africa, in the UK, just to give you, the 4 corners of the world. I'm pleased to say we're pretty good at selecting the best managers out there.
Okay. And I think it's for that reason why, as the Equilibrium team, we actually were very comfortable to appoint the MGIM team to be doing that manager selection, that asset allocation calls for us. I think let's pivot a little bit and move on to investment philosophy. So I think many of us, when we're studying back in university days, we were taught how markets are efficient. And then you enter the real world and you suddenly realize and question whether that actually is truly the case. I think from an MGIM perspective, what's your approach as to how you construct portfolios? And maybe if you're able to also touch on, where you see sources of returns.
Well, I think, put simply, reason why markets are inefficient, or at least not as efficient as they tell you, is because market participants are humans, just like you and I. And, we've got biases. We sometimes panic, sometimes are rational, sometimes don't underappreciate or overestimate consequences of things, and that creates opportunities. And one of our jobs is that of making sure that we take advantage of these opportunities when they arise. As for sources of returns in our multi-asset portfolios, there is a handful, but I would say 3 key things are driving long-term risk and return expectations. The key cornerstone, which is a strategic asset allocation that the portfolios will move around for their existence. But then we try and add value by successful manager selection, as I mentioned earlier in our chat, but also by taking some tactical asset allocation views whenever markets present opportunities, which very often happens during periods of volatility or maybe of extreme market conditions, as we've gone through for the past few months.
Yeah. So I think, definitely, you touch on something, the fact that, by looking offshore, you're also then getting access to that much broader investable universe. Because, if you look at South Africa from a global market cap, it's a tiny, tiny little number. And part of the reason why when you're, building your clients' portfolios as an advisor is that you also want to be looking at global, largely maybe for 2 reasons. Maybe to try and eliminate that country bias that you tend to have. Because generally, if you live in a particular geographic location, you will be biased to just picking stocks that you're familiar with and brands that you're familiar with. But there's a much bigger universe out there. So I think that's the one benefit. And I think the other one is exactly that. You just want to tap into more asset classes than maybe what's available in a South African context. So that diversification benefit, it's a premium that you can leverage off. But I think when you talk offshore, it's not without, obviously, that natural tension that comes between risk and return. So that trade-off that you constantly always have to be considering. So I think my question to you, Lorenzo, is that when it comes to investments, we know that it does come with certain risks. And I mean, right now, the environment that we find ourselves in, there's talk of tariffs. Nobody knows where that's going to come off. There's still geopolitical tension. I still can't believe the war between Russia and Ukraine, that's still ongoing. There's risk of inflation actually maybe ticking potentially upwards. From a MGIM perspective, how do you guys define risk and how do you think about risk?
Wow, tough question. Again, just to compare to university times, they teach you that risk is volatility. And that's a concept that I always struggle with because volatility is only one of the many things. Risk can be permanent erosion of capital. Risk can be selling out of an investment at the worst possible time and buying in too late. There's many things. Ultimately, what we try and achieve is clients' financial satisfaction. Okay. And risk is something you need to embrace in the portfolios. There's no way you can avoid it altogether. Otherwise, there is no returns for you. But you can manage it, and you can do so with what I like to call, true diversification, which is not only invest globally, invest across a variety of asset classes and sub-asset classes, but also make sure that the portfolio is not reliant on only one story. Because ultimately, the one story can change direction of travel, and you can end up indeed losing permanently some capital, which we want to avoid. So it's all about diversification and about portfolio construction that is meaningful and based on a look-through basis of your investments.
Yeah. And I think what we also typically see, with investors out there is that when there's a lot of risk or concern about risk, everyone floods into the safe haven assets. So maybe let's touch on gold, right? Gold's been up. I think you shared a statistic with us earlier in a previous conversation that 100% over the last 3 years. So it's been the best performing asset class. Yeah. And I'm not sure how many people saw that coming. I certainly didn't. That took me by surprise. What's your view on gold? Is it still this old economy, stable, safe haven status that it holds? Is it still the great diversifier? And I think maybe more importantly to someone who's listening to us, would you be a buyer at these current levels?
Wow. Well, gold, I think, remains a great diversifier. Gold doesn't depend on the business cycle, or at least, it doesn't correlate with equities and bonds, which anyway are the majority of our investments in the multi-asset space. So gold remains extremely important. And like yourself, 3 years ago, I did not expect gold to go up 100%. And yet I had some. And I did because in a multi-asset context is very important. And again, back to my previous comment about diversification, you want to have asset classes that rely on different dynamics to manage risk and embrace it to maximize returns. And gold is one of those. Would I be a buyer at these levels? Probably not. We're not particularly negative on gold. We think there is a lot of sentiment in its favor, a lot of tailwinds. Certainly, we're still going through very volatile times, and gold typically does well. And the buying pressure, which is what's been driving prices up for the past 3 years, is still very much there because people were underinvested in gold up to some time ago. However, downside risk is significant. If markets calm down a little bit and people start looking elsewhere, gold could easily face a correction. So at the margins, no, I would not be adding gold right now. We're happy with the way we're positioned, which is about neutral.
Okay. So I think maybe, sticking on as a multi-asset manager, the point that you made, it's all about that diversification. That's how you manage risk, looking at different asset classes. So maybe let's pivot a little bit and maybe go a little bit more defensive and touch on global bonds. So if you look at bonds, they've been an unloved asset class because for some time leading up to the pandemic, you're getting almost 0% for bond yields, but that is changing. I think what's your view on bonds at the present time?
Well, we're positive on gold. On bonds. Apologies. Where they yield 4.5% in the States, give or take, depending on what maturity you look at. They yield less in Europe, 3.5, depending on the specific regions you look at, which is a great starting point. Not only the expected return, which is very correlated to the starting yield, is higher than it's been for the past decade, but also that space allows central banks to cut rates more should economies, fall into a recession or anyway struggle with growth. So not only the expected return is higher than it's been for a while, but the downside protection, that ballast effect against equity risk is very much reinstated, which we like.
Okay. And I think, moving on to equity. So you teed us up quite nicely, going to a different asset class, looking at global equities. I think, global equities for the last couple of years, for most investors, you didn't have to do much work. If you just stuck your money on the S&P 500 passive tracker, you did very well. You were handsomely rewarded. However, I mean, with all the uncertainty that's happening in the markets right now, would you agree if I made the statement that maybe now it's time for active managers to shine, and now it's actually time for your stock pickers to come to the forefront?
I definitely agree. The reason why passive investments have done so well in the recent past is also because they happen to have a very high allocation to the best stocks, those that benefited the most from AI, from globalization, from those couple of themes. They call them the Magnificent Seven, and they were magnificent. They are great stocks and great businesses. But the US market in particular has gotten to a point where the concentration risk was and is still very high. And it's all relying on one theme, which is that of AI. Even though I think AI will remain extremely important, I do think it will be benefiting many more stocks. And it is a good time to be active, because being active and being different from benchmark allows you to buy into undervalued stocks, buy into defensive stocks, and avoid that concentration risk that is present in the index. We've seen already year to date, actually, active managers do, on average, pretty well, as the Magnificent Seven have faced a tough time, a significant correction in Q1 this year.
Okay. So I think, one of the things about your team, Lorenzo, and one of your core beliefs is the fact that, you firmly believe that not one manager can be good at everything. So your core belief is to actually buy specialist managers. Maybe you can actually talk us through that, and maybe potentially even use an example of maybe an interesting manager that you're holding and who's looking at a part of a market that maybe others are ignoring, just to demonstrate that for us.
For example, I'm thinking about a US manager that is held into the equilibrium models, and they've always invested in one very specific style, which is, they call it quality value, with the addition of analyzability, which is always a word I struggle with. But these in an environment where everybody was just looking at high growth US tech stocks, markets forgot about mid caps, they forgot about value stocks, they forgot about cheapness and about the consequence that cheapness has on long-term returns. And that one specific manager instead has been always fully focused on that part of the market, that of stable businesses that maybe trade at discount to intrinsic value, that are very cash rich and can use that cash to unlock that valuation. And I think that style is really positioned well for the foreseeable future.
Okay. So you gave an example of a US-based manager. So EM versus DM, what would be your preference?
Oh, wow. Right on the spot.
Right on the spot.
Let's consider both risks and returns. EMs are riskier than DMs, just by, naturally they're like this. And we like EMs. We think there is a lot of great companies. There's a lot of growth that is absent in DMs, but clearly is a very concentrated market. China is 30% of it, and China right now is on a good recovery. Especially, I think it's very fresh news that China and US seems to have struck a sort of deal on tariffs, which is giving them a nice boost. But we're conscious that when concentration is that high, things can revert direction easily. DMs are also, even if not more concentrated, 70% in US. And like I said, we're not particularly excited about the S&P 500. But if you manage to go active and avoid that benchmark risk and be differentiated, then it's a lot better. EM versus DM. Right now we have a slight underweight to DM in favor of EMs, mostly because of a US underweight. But strategically, I would like to have both. They nicely compensate each other.
Okay. Okay, so this one, like, I'm going to put you on the spot.
Again, you've done it already twice. Come on.
I'm having fun. Like, whilst you're here, like, let me put you on the hot seat a little bit. I love the way whenever you engage with our clients, like, you always position the fact that, you know, as an investment professional, you can never use the word forecast, or you can never use the word definite or guarantee. So these are things which I think our compliance team will be very proud of us. And you always like to use the word guess instead. So I'm going to stick to your language and your vocabulary. What would you say would be your best guesses for the next 12 months? So to our listeners that are listening in and they're wondering, like, you know, what can we expect potentially in the next 12 months? Yeah, what would be your best guesses?
Well, one I mentioned already earlier, I think AI will keep driving growth, but not in the way we've seen so far, not concentrated in the bigger names, in the tech producers, in the hardware.
That's interesting.
I think everybody will be benefiting from AI, even, you know, non-tech companies, even, you know, financials like ourselves will be increasing profitability thanks to the use of AI services. And that's going to drive growth everywhere and help growth, I guess. Other guesses, I believe we're not going to face a recession. That's my base case. I think growth will be positive, although moderate, I guess, everywhere. We think inflation is under control, which I believe be very important dynamic to keep an eye on, because we've seen so far how cautious the Fed has been in cutting rates, mostly because they were not certain of inflation. And even though it's still, you know, an uncertainty, I believe it is under control and is going in the right direction. Other guesses, I guess, rates as a consequence of growth and inflation, we believe they are coming down. In the US, they're currently higher than Europe, and probably they will stay higher than Europe, mostly because the US now at least, has got a bit of a higher inflation number, and it remains to be seen the consequences of tariffs, what they will be. But aside from that, we think rates are on a downward trajectory and normalizing around long-term numbers. And my final guess, which shouldn't come not as a surprise, I guess, is that equities are back to normal behavior. When I say normal, I mean volatile. I mean diverse and dispersed. Again, it's the times where equity investments was an easy thing to do, just buy S&P and hold on to it. I think they're behind us. The easy returns are behind us. Now we need to be active, we need to be attentive, and we need to be a bit smarter about constructing portfolios to make sure we navigate the future better.
Yeah, and I think, I mean, thank you for that reality check, because I think sometimes we do forget that, yeah, the last couple of years has been a bit of an anomaly. Like when you say equities are going to start behaving normally, you know, it kind of takes you aback, but you are right. The last couple of years have been very easy. Stick your money in passives and Bob's your uncle. You did reasonably okay. I think maybe, you know, to close us off, Lorenzo, if you can just maybe share certain key themes that you'll be keeping an eye on over the next maybe short to medium term period.
Well, I think from a call it macroeconomic and high-level perspective, it's very important to keep an eye on tariffs and how they evolve. We seem to be making progress, or at least that's what President Trump is saying. But you know, the economic reality remains to be seen, and that will play a significant role on inflation and on growth. So want to really be mindful of. At a more, you know, fundamental level, I guess, we are positioned in favor of defensive stocks doing better than those more aggressive and cyclical. We're positioned in favor of value to beat growth. And we quite like actually small and mid caps as opposed to the mega caps especially. Okay. And obviously you always need to be very risk mindful when you make asset allocation calls and never deviate too much from the strategic asset allocation, which, as I mentioned, is the key driver of long-term returns and risks. But it's also important to position yourself to take advantage of certain opportunities, and these areas are where we see the better opportunities right now.
Thank you, Lorenzo. Thank you for those great insights. And it was fantastic being in conversation with you. And thank you to everyone that joined us today. I hope through this vodcast we've demonstrated how Equilibrium can help you as an advisor bring that balance back into your practice. By you partnering with Equilibrium and using our global model portfolios, it'll free you up to spend a lot more time in front of your clients doing your financial planning. The reason why we expertly crafted these 3 global model portfolios was to remove the complexity away from the advisor. So what we did is we kept it very simple. It's 3 risk profiled global model portfolios to remove that choice conundrum that I think many advisors that are sitting in a South African context trying to make those calls as to which geographical location to invest in, which asset class, which fund manager, which currency. There's a lot of complexity to be able to actually make that. By you partnering with us, Equilibrium becomes an extension of your practice. Thank you.
For more information, visit eqinvest.co.za. You've been watching the Frequency Vodcast by Equilibrium. Thank you for watching.